The Korean stock market, up 189% in 16 months.
So, did Korean investors make money? They did not. Right at the start of the rally, they sold. $10 billion out the door. Clean exit. Wrong direction. In hindsight, it was a perfect bottom call, just in reverse. And then they bought back in, near the top, obviously, because that's how this always goes. Now here's the part I want you to sit with. These were not beginners. These were people who followed Korean companies every day in their own language from the inside. If anyone should have seen it coming, it was them. They still sold the bottom and bought the top. You think this is a Korea problem? It isn't. And I'm going to show you exactly why, because the same mechanism is sitting inside your portfolio right now, waiting for the next down day to fire. Let me show you exactly how this unfolded. At the start of 2025, the Korean stock market, the Kospi Index, was sitting at 2,399. It had just absorbed a sharp, sudden shock at the end of 2024 that sent the index sliding hard below 2,400. Foreign investors started pulling money out. Sentiment was bad. The headlines were worse. And Korean retail investors, watching their portfolios shrink in real time, started making decisions. For the first 6 months of 2025, almost nothing visible happened. The index ground sideways, dipped, recovered a little. Most retail investors who had not already sold were waiting for a reason to feel better before they put more in. Then something shifted. The global demand for artificial intelligence infrastructure hit an inflection point. Every data center being built at scale needs memory chips, specifically a type called high-bandwidth memory. The companies that manufacture it at the level the market required were Samsung and SK Hynix, both Korean, both sitting at valuations that had been structurally depressed for years. When the AI capital expenditure cycle ignited, it ignited directly underneath the Korean market. In a single month, the Kospi gained 31%, the strongest monthly performance since January 1998. Samsung ended the year up 125%. SK Hynix nearly quadrupled. By the end of 2025, the Kospi had returned 76% for the year, the strongest annual performance of any major market on Earth, more than 4 times the S&P 500's 17% gain. Then it kept going. By late April 2026, 6,937, up 189% from the January 2025. That's not a metaphor. That's the math. Now here is where it gets painful. The $10 billion that Korean retail investors sold in the first half of 2025, if it had stayed fully invested through the recovery, would be worth approximately $30 billion today. The difference between selling and holding across that single capital base is nearly $20 billion, not from picking better stocks, from not selling the ones they already had. They sold Korea to buy American leveraged ETFs. At the exact moment Korea was about to triple, if you designed a test for bad timing, this would be the answer key. They panicked. Understandable given the circumstances. Bad timing, but human. Here is what that explanation gets wrong. These were not inexperienced investors. Korean retail participation in financial markets is among the highest in the developed world. These investors track earnings, monitor macro data, and understand the companies they own at a level most American retail investors never reach for U.S. stocks. The sellout is not the result of bad investors making bad decisions. It is the result of a cognitive system operating exactly as designed in an environment it was never designed for. Panic is the wrong diagnosis. And the right diagnosis is what is going to cost you money if you leave this video without it. If this was not panic, if it was a precise, predictable mechanism running on schedule, why does it fire in people who know a market cold, and what is the exact sequence that converts real information into the worst possible financial decision?
I want to try something. Imagine I flip a coin right now.
Heads, you win $200. Tails, you lose $100. The math on that game is clearly in your favor. The expected value is positive. Every time you play, the odds work for you. Most people will not play. Not because they cannot do the math, because the $100 loss feels heavier than the $200 gain feels light. Psychologists have measured this. The pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. This is called loss aversion, which is just a fancy way of saying your brain is not a calculator. It is a survival machine that treats financial loss like a physical threat. Now take that bias and drop it into a falling market. Your portfolio drops 20%. Loss aversion fires. The pain signal your brain generates is disproportionate to the actual dollar figure. It feels like a threat, not a statistic. Then your brain does something else. It looks for the most recent vivid event to use as a prediction tool. Right now, the most recent vivid event is the drop. That drop becomes the brain's primary forecast. This is called availability bias, which is just a fancy way of saying your brain uses whatever happened last as the template for what happens next. Not historical data, not base rates. The last thing that was scary. Loss aversion makes the pain too large. Availability bias makes the pain feel predictive. And then the third piece locks it in. Whatever just happened feels permanent. The drop does not feel like a temporary event in a long sequence. It feels like the new reality. This is recency bias, which is just a fancy way of saying the present always feels more durable than it is. 3 mechanisms. 1 output. A sell decision that feels completely rational in the moment and is structurally guaranteed to be wrong at the worst possible time. Now let me show you what this looks like in a real portfolio, with real numbers. David is 35. He has been investing in a broad S&P 500 index fund for 4 years. In early 2020, his portfolio is worth $50,000. He has done everything right. Then, COVID hits. The S&P 500 drops 34% in 33 days. David watches his $50,000 shrink to $33,000. Every morning, it is a smaller number. Every headline confirms the fear. Every economic model projects extended pain. Loss aversion is running at full intensity. The COVID crash is the most available event in his brain. The drop feels permanent. In late March 2020, David moves to cash. The S&P 500 bottomed on March 23, 2020. David sold into the bottom. He waits. He watches the market recover, but the news stays cautious. He waits until the recovery feels confirmed. He reinvests in March 2021, 1 year after the low, when it is obvious things have stabilized. David did everything right. He followed the news. He read the reports. He made a rational decision. The market did not care. By April 2026, David's $33,000 has grown to approximately $59,000. The investor who held through the crash, same fund, same starting amount, did not sell once. Approximately $109,000. Same person, same fund, same market, $50,000 difference. From one sell decision made under maximum emotional pressure at the single worst possible moment. Now here is the number that should change how you think about every future drawdown. Dalbar, a financial research firm, has tracked this behavior across millions of investors for over 25 years. Their finding, the S&P 500 has returned an average of approximately 9.8% per year over the last 2 decades. The average equity fund investor over the same period returned approximately 5.5% per year. That 4.3% annual gap, compounded over 20 years on a $50,000 portfolio, is the difference between $314,000 and $146,000. $168,000 gone. Not from fees, not from picking the wrong stocks, from timing decisions that each felt rational in the moment they were made. The Korean retail sellout of 2025 is the Dalbar data, visible in real time at national scale.
Now you might think, I know about these biases now. Knowing changes the outcome.
Here is what 25 years of Dalbar data says about that. It does not. Knowing the bias exists does not neutralize it. The emotional pressure during a real drawdown is not removed by intellectual awareness. The mechanism fires regardless of whether you can name it. The investors who consistently avoid this outcome do not do so because they feel less fear. They are just as afraid. They do so because they made the sell decision before the fear arrived. And they did it in writing. If emotional awareness alone cannot neutralize the mechanism, and the mechanism fires in informed investors across every major market dislocation, what is the specific pre-commitment structure that consistently keeps investors in the market during the exact moments that destroy retail returns?
Before I show you the framework, I want to show you something that should permanently change the way you feel about selling into a drawdown.
The $9.2 billion that foreign institutional investors put into Korean stocks in the second half of 2025 did not come from a crystal ball. It came from knowing with high confidence that retail investors were going to sell. Institutions run behavioral finance research. They model retail investor response patterns to market dislocations. They know from Dalbar data, from their own flow analysis from decades of pattern recognition, that retail investors reliably sell into sharp drawdowns. They position in advance at lower prices and wait. The retail sellout funds the institutional entry. Every time, in every major market, on every significant dislocation. The $9.2 billion that foreign institutions made on Korean stocks in the second half of 2025 was paid for by Korean retail investors. Not through fraud, not through complexity, through the predictable, reliable, on-schedule activation of loss aversion, availability bias, and recency bias. The cognitive architecture producing the sell decision has not changed since 1998. They are always right about this, because you are always going to be human. The question is not whether they will set up that trade the next time. They will. The question is which side of it you are on. Markets recover faster than the news cycle because markets price the future and news reports the past. Sentiment follows price. Price bottoms before sentiment does. By the time any headline confirms stabilization, the market has already priced in that stabilization and moved. The investor waiting for confirmation is not buying at the bottom. They are buying into a recovery that has already happened, at prices that already reflect the improvement they were waiting to see. This is called opportunity cost, which is just a fancy way of saying every month your capital sits outside the market is a month of compounding that does not exist anywhere in your future net worth. It is not delayed, it is gone. This is why David's $33,000, reinvested after 1 year of confirmed recovery, grew to $59,000 instead of $109,000. The 12-month window of maximum recovery that he waited through is the irreplaceable variable. Most investors who sell during a drawdown intend to buy back at the bottom. Here is the structural problem. The bottom is only identifiable after the recovery has already begun. The lowest price is not labeled. There is no signal visible at the moment of the actual low that distinguishes it from every other declining day before it. The signal only becomes readable in retrospect. By the time any observable confirmation of the bottom exists, the market has typically moved 15 to 20% off the low. The tax event from the original sale, combined with the missed initial bounce, produces a permanent deficit. Buying back at the bottom is not a strategy. It is a description of what you intended to do, written after the fact, by the version of you who watched it happen without participating. Now here's the framework that changes this. The investors who captured 189% in Korea, who held through March 2020, who stay in through every dislocation, are not operating on willpower. They are operating on a written policy that made the sell decision before the fear arrived. This is called a policy-based investment framework, which is just a fancy way of saying you decide what you will do when markets fall before markets fall, and you put it in writing. The policy contains 3 things. 1, your time horizon for this money. A specific number of years, not a range. 2, the maximum drawdown you will hold through without selling. Not a vague commitment. A specific percentage. Write it down. 30%, 40%. Whatever the number is, it has to exist on paper before the drawdown happens. 3, the conditions under which you would reduce your position. These must be specific and non-emotional. The market falling is not a condition. Your employment situation changing such that you need the capital within 12 months is a condition. When the drawdown arrives, the policy converts an emotional, real-time decision into a procedural one. The question is no longer, should I sell? The question is, does my situation meet the conditions I wrote down? If the answer is no, the policy answers for you.
Most retail investors do not have this. Every institutional investor has had it in writing since before the first trade was placed.
The mechanism is clear. The framework is clear. The one remaining question, given exactly where you are right now in terms of portfolio size and financial stage, what does this framework tell you to do today? 3 tiers. Your move depends on where you are. Your only job at this stage is building the habit of staying in. Open one broad index fund, U.S. total market or global total market. Set up an automatic monthly contribution. Whatever amount does not require a decision each month. Then write your policy today, before the next dislocation. I will not sell this position for any reason other than a documented personal financial emergency. Sign it, date it. Put it somewhere visible before you open your brokerage app. At this stage, the behavioral habit is worth more than the starting amount. The investor who starts with $2,000 and earns 9.8% annually for 20 years ends up with more than the investor who starts with $5,000 and earns 5.5%. The gap is not the principal. The gap is the behavioral tax applied every year. At this stage, geographic concentration becomes a real risk. Add international exposure. Your portfolio does not need to predict which market performs next. It owns all of them, so the prediction becomes irrelevant. Then write your full investment policy statement, your time horizon, your maximum drawdown threshold, your rebalancing rules. The policy should make the sell decision automatic. My policy says I hold through a 40% drawdown. Therefore, in a 40% drawdown, I hold. One sentence, no deliberation required.
At this stage, a single mistimed exit produces a permanent impact on your retirement outcome.
Audit your allocation for home country bias. The average American investor holds 70 to 80% of their equity allocation in U.S. stocks. The U.S. represents approximately 60% of global market capitalization. That excess concentration is not a diversification strategy. It is recency bias expressed as an asset allocation. The U.S. has outperformed for 15 years. That is a data point, not a structural guarantee. Consider a 10 to 15% allocation to international developed markets through a low-cost ETF, not because Korea or Japan will outperform, because you do not know which market will outperform, and a policy of owning all of them removes the timing decision permanently. Review your policy annually, not quarterly. Quarterly review increases the probability of emotional intervention. Annual review keeps the time horizon in front of the short-term signal. 2 people, same market, same starting point. 5 years later, one has $9,000 more. 10 years later, $54,000 more. 20 years later, structurally different options. Same person. The only variable was a written policy, prepared once, before the fear arrived. You now know something specific. The market is not the risk. The behavioral tax, collected at the moment of maximum fear, is the risk. It has a name, a mechanism, and a solution. The solution doesn't require courage or intelligence. It requires a document written today, before the next dislocation sets up.
The mechanism will fire again. The question is whether you've already answered it.
This happens. Markets drop 10, 15, 20% in a matter of weeks. It happened last year. It happened earlier this year. No warning. What did you do? Drop it in the comments. Sold, held, or bought more. If you held, say so. If you sold and bought back in, tell me when. That thread is going to be more honest than anything I just said. And if this changed how you see it, like and subscribe.